At 1:17 a.m. in a quiet corner of the Treasury market, a number prints that almost no one outside a dealing desk will ever see. A weak auction result, a small tail, a subtle stumble in the most important funding machine on Earth. Nothing explodes. No sirens, no emergency broadcast. The headlines don't even notice. But this is how empires age in the modern era, not with invasion, with refinancing. The camera everyone points at is the $35 trillion debt total. A cathedral-sized number designed to overwhelm the mind. But the number that should keep you awake is smaller, and it moves like a metronome. Interest. For the first time in modern U.S. history, net interest costs have risen to the point where they rival, and in some measures surpass, national defense outlays. You can verify the trajectory in the Treasury's monthly Treasury statement and in the St. Louis Fed's FRED database. A country can survive almost anything, except compounding, because compounding turns policy into physics. And this is the part no one says plainly. When the interest bill becomes politically untouchable, the government does not ask permission to solve it. It changes the environment you live in until the problem looks smaller. Most people think the endgame is either default or hyperinflation, but there is a third outcome, quieter, more professional, a mechanism that preserves the bond market, preserves the appearance of order, and transfers the cost onto you through the unit of account. Stay with me, because once you see the plumbing, you'll recognize the signs early. And you'll understand why the reset can happen without a vote, without a new tax, and without anyone using the word default. So what does any of this have to do with your savings account, your pension, your mortgage, and the price of your groceries? The comforting story is that the Federal Reserve is the brake pedal. Inflation rises, the Fed raises rates, borrowing slows, demand cools, prices stabilize. Mechanical, tidy. But that story assumes the brake is still connected to the wheels. When debt becomes large enough, the linkage flips. The brake pedal becomes the accelerator, and that inversion has a name: fiscal dominance. Here is the trap. The U.S. government funds itself by issuing treasuries. Much of that debt matures and must be rolled, constantly. When rates rise, the cost to refinance rises. The government's interest bill swells, deficits widen, and to cover the widening gap, more treasuries get issued. More issuance means the market must absorb more bonds, which often requires higher yields, which increases the interest bill again. A feedback loop. Not a scandal, not a conspiracy. Arithmetic. If you still picture the debt as a mountain, you miss the danger. This is a conveyor belt that cannot stop. And the faster it runs, the hotter the bearings get. Across history, once sovereign debt climbs into the range of roughly 120 to 130% of GDP, interest sensitivity becomes brutal. The exact number varies by country and measure, but the behavior is consistent. Small rate moves become budget earthquakes. The U.S. is now operating near that zone depending on measure, tracked by the Treasury, the CBO, and FRED. Argue the percentage if you want, you can't argue the direction. And now the Ouroboros, the snake that eats its own tail to survive. Old bonds mature. New bonds are issued to pay them off. But the new bonds carry higher interest. So next month, even more bonds are needed. And the interest meter keeps running. This is why just cut spending is not a complete answer. Do the uncomfortable math. Even cutting large, visible items doesn't necessarily neutralize a deficit when interest and mandatory obligations keep compounding underneath. Interest is not a program you can cancel. It is the price of yesterday's decisions, invoiced today. Pause on that. When interest becomes one of the largest line items, what exactly is the political plan? To cut the past. When nations hit this wall, they rarely choose the dramatic ending. They don't announce bankruptcy. They redesign the rules. They regulate the flow of money. They cap rates. They compel institutions to hold government bonds. They discourage exits. The historical name is financial repression. It doesn't steal your money outright. It steals what your money can buy. It works by pushing interest rates below inflation for long periods. Your account balance can rise, while your purchasing power sinks. And the signature tool when needed is yield curve control, YCC. Under YCC, the central bank draws a line in the sand on government borrowing costs. If markets demand higher yields, the central bank buys enough bonds to force yields back down, effectively capping the government's interest expense. This has precedent. The United States used yield pegging in the 1940s to finance war and post-war debt. Japan has run modern variations for years, pinning long-term yields through central bank purchases. But this time, the background is less forgiving. Post-war America had a roaring industrial base, trade advantages, and creditor status. It could grow out of the burden. Today, the U.S. is the world's largest debtor, running persistent trade deficits and relying on global confidence to keep financing cheap. The growth engine is weaker, and the supply chains are more fragile, so the same medicine can have sharper side effects. Here is what financial repression feels like. Your pay rises but slowly. Your savings earn interest but not enough. The cost of housing, insurance, food, and energy keeps stepping upward. And each year, you need a little more effort to stay in the same place. If the state can't default openly and can't raise taxes enough to close the gap, what remains other than shrinking the real value of what it owes by shrinking the real value of the currency? Every debt spiral still needs a catalyst. A moment when the private market stops cooperating. For the U.S., that moment is a Treasury auction that fails or effectively fails. Weak demand, rising yields, larger tails, shrinking participation by price-insensitive buyers. Treasure this fact. Treasuries are not just investments. They are collateral for the financial system, a benchmark for mortgages, corporate borrowing, bank portfolios. When Treasury yields jump, the shock travels everywhere. Now add geopolitics and balance sheets. Foreign official buyers have reasons to step back. They may need dollars at home, defend currencies, diversify reserves, or reduce exposure to U.S. policy choices. If foreign demand softens while issuance rises, yields rise to clear the market. Higher yields inflate the interest bill, which drives more issuance, which demands even higher yields. This is the Minsky moment approaching, the point where the system cannot sustain market rates without breaking the economy around it. At sustained 6 or 7% funding costs across the curve, the federal interest expense becomes politically impossible. Not because the U.S. can't create dollars, it can, but because creating them at that scale changes behavior. Prices, wage demands, risk premiums, and trust. And then the pivot. The Fed becomes the buyer of last resort, not for elegance, for survival. It buys to cap yields, to keep auctions clearing, to prevent the bond market from becoming a trapdoor. This is the third outcome. Not a declared default, not instant hyperinflation. A managed devaluation through repression, capped rates, and monetary expansion. A transfer of wealth through the unit itself. Look at the illusion it creates. Asset prices may surge in nominal terms. Stocks, homes, collectibles, even wages can print higher numbers. But if the currency buys less, you are not richer. You are just counting in a thinner unit. If your portfolio rises 12% and your living costs rise 18%, what happened to your wealth? It didn't vanish, it evaporated. Now we leave diagnosis and enter survival. The goal is not to beat the market. It's to preserve purchasing power in a regime where safe returns can be structurally negative in real terms. Financial repression is redistribution. Those closest to newly created money benefit earlier. Large institutions, leveraged asset owners, governments refinancing in cheaper units. Those farthest lose quietly. Cash savers, cautious retirees, wage earners whose adjustments come late. So what can you actually do? First, opt out of the denominator as much as your life allows. Own some assets that cannot be printed into existence. Historically, gold has been the blunt instrument for this. It is not perfect, but over long periods it has tended to hold value against expanding fiat supply. Silver behaves similarly with more volatility. Land can work, especially productive land, but it carries taxes, regulation, and illiquidity. And then there is digital scarcity. Bitcoin. Not as a slogan, as a property. A bearer asset with a fixed supply schedule enforced by a network, not a ministry. Ask yourself one clean question. If capital controls tighten, if withdrawals slow, if custodians become gates, what do you truly own outright? Because custody is part of risk. A bank deposit is a promise. A brokerage account is a chain of counterparties. Many assets are only yours as long as the system is calm. Self-custody, where appropriate and understood, reduces reliance on permission. Physical precious metals and properly self-custodied digital assets are not claims on someone else's balance sheet. Second, understand fixed-rate debt. In an inflationary repression regime, fixed-rate debt can be a shield. If you locked in a long mortgage at low rates and inflation runs hotter than that rate for years, the real burden of your payment shrinks, provided your income holds. It is not magic. It is the arithmetic of being on the right side of devaluation. Third, avoid the trap of safety, defined only by nominal stability. A bond that pays 4% when inflation runs 6% is stable only in appearance. It is a slow transfer from you to the issuer. Now hold the central idea in your mind. The $35 trillion isn't just a number. It is a timeline, a schedule of refinancing that must clear, month after month, in a market that demands compensation for risk. The reset is not guaranteed on a specific date, but the direction is mathematically constrained. The interest burden pressures policy toward repression, toward caps, toward subtle forms of default. And you can watch the timeline in 3 places. 1. Treasury auction tails, bid-to-cover ratios, and the share taken by indirect bidders. Weak demand is the first crack. 2. The 10-year yield. If it breaks above 5% and holds, refinancing stress intensifies and the incentive to cap grows stronger. 3. Gold priced in foreign currencies, not just in dollars. When it grinds to highs across multiple currencies, it's a signal the unit is weakening broadly, not just locally. The debt is their liability, but the currency is your liability. Choose your liability wisely. I'll see you in the next file.